Today we're going to discuss why wealthy people buy so much life insurance. My name is Amanda Ryba, and it is my goal to illuminate to the world what the wealthy do with their money. So stick with me. One main reason why wealthy people purchase so much life insurance is because of what's called estate taxes. Now, this obviously depends on the state that you live in. However, the state tax exemption is $12.92 million. So if you have built up an estate that is valued in excess of $12.92 million, everything you own in excess of that will be taxed at estate tax levels when you pass away and it's inherited by your beneficiaries. One thing wealthy people have discovered is that if you purchase enough life insurance to cover your estate taxes, now your entire estate can transfer all to your family without having to worry about any additional taxes being paid. If you are not at that threshold yet, or nowhere near it, there is still a benefit to you owning life insurance to protect your estate. And there's two main types of life insurance that we can talk about. There is term insurance and there is permanent insurance. Term insurance, think temporary. It's going to expire at a certain point. You can purchase it in increments of 10, 15, 20, 25, and 30 years, meaning after that 30 years is complete, the policy is done. Think of it like you are purchasing car insurance. If you don't use it, you lose it. Now, I will say there's term policies today that are pretty spectacular. They come with a feature called living benefits, which means if you were to get critically, chronically, or terminally sick, ill, or injured, you can actually access money out of that death benefit while you are alive, while that term is active. So there is a much higher percentage chance of you getting sick or injured between now and 30 years from now than passing away. So if you are looking into term insurance, it is some of the most affordable type of life insurance you can purchase. It will literally increase and enhance the value of your estate from the day that you purchase it. And then from there, that insurance can be used to pay off your home when you pass away, pay off any debts that you have, and make sure that your money and everything that you own, your assets, transfer easily and quickly to your beneficiaries when you die, without them having to work with any unexpected expenses that come up. Then we also have the permanent life insurance side. Permanent life insurance is designed to last you for as long as you live. It doesn't ever expire. As long as the cost is covered, you'll have it for as long as you live. And there's 4 different types of permanent life insurance. First that came out was whole life. It is the oldest and most traditional and most well-known kind of permanent life insurance. It does grow a little teeny tiny cash value that's based on dividends and how the insurance company is performing. You maybe will see an extra 4, maybe 5% a year max in interest accredited to the cash value that's going alongside that policy. And what I mean by cash value is everything in excess of what you contribute into that policy over the cost of the policy will go and give you like a little cash value bucket that's going to grow and earn interest and get those dividend credits added to it. Then from there, they came out with something called universal life insurance, which really just means flexible premium, meaning you put in a little bit more on a monthly basis. It does not earn interest based on dividends. So you'll see those average maybe 5-6% rate of return, give or take the company and the policy. Then from there, they came out with variable universal life insurance because the stock market was doing great, right? In the 80s and the 90s, well, the 90s specifically, and people wanted their cash value to participate in the market. Hence variable universal life. It is exactly as it sounds. Your cash value, everything in excess you're paying on that policy is going into that cash value bucket that's now going to grow in the stock market. You can imagine how well those are doing right now. And then from there, because people didn't want to take on the volatility and the risk of the stock market, insurance companies partnered with a strategy that had been around for well over 100 years called indexing. And they put indexing inside of the life insurance, and now it's called indexed universal life, where now your cash value is not in the stock market, it's not dealing with dividends, it's actually tracking a stock market index, like an S&P 500, like the Dow Jones, something like that. And then you're going to get a mirrored reflection of that performance on your account. So when the market does well, your account's going to grow, but the key feature is when the market goes down or it goes negative, your cash value gets locked in. They give you a 0% floor. Now, that may sound a little bit too good to be true to some of you, and I can see why, but it's not too good to be true, it's just too good to be free. The way the insurance companies are able to give you all the growth but with no risk is they're going to charge you for that. You're either going to get capped on your growth, they're either going to charge you potentially a spread, meaning they take a piece of your profit, or they could simply just charge you a fee, which is what you would pay to be in a variable product anyways, but in an index universal life, you just, in place of that fee, you get 0 risk. right? So they're kind of insuring you against loss. But all 4 options on the permanent life insurance side are permanent life insurance. They will last you for as long as you live. Again, the key when designing life insurance in your financial portfolio is you want to make sure you have enough insurance to cover any estate taxes that you might have and cover any debts, pay off your mortgage, make sure your kids are taken care of, and of course replace your income for your family. So again, big reason why the rich and the wealthy purchase so much life insurance is because they are at such a huge liability for estate taxes. And again, keep in mind that's different in every state, but you may not have an estate tax liability, but you probably have other liabilities to your family like debts, income, things like that. So I recommend you take a look at both. Term insurance, again, super cheap, very affordable, only gonna last you for a certain amount of time. Really good during your most vulnerable years, which is your 30s, 40s, and 50s, and 60s, while you have debt you're paying off, a mortgage you're paying off, kids you need to support, a family you need to support, things like that. And then the permanent life insurance will last you for as long as you live. So usually you'll get more term insurance than you will permanent because term is cheaper. And in theory, when that term insurance policy falls off, you should be somewhat self-insured by the time you retire with investments and retirement accounts and things like that. And then you'll have your permanent life insurance to last you for a little longer. However, I will say, I meet people all the time in their 50s and 60s that wish they started saving money sooner, and they also wish they purchased a lot more life insurance and to last them a lot longer in life. So keep that in mind when you are looking at this. If you are open to exploring the options on the life insurance side, maybe you have an estate tax liability or you have other financial liabilities that you're concerned about, you don't want your family to take over when you pass away, I am happy to help. If you live in the United States, you're welcome to reach out to me or somebody on my team. There's a link in my bio that you can click to work with us directly. And if you live in another country, I recommend you connect with a licensed financial professional where you live that can help coach you through your options. And again, this is Amanda Ryba, illuminating to the world what the wealthy do with their money and why they do it. If you like videos like this, I put out a new video every single week. So you're welcome to subscribe to my channel and turn on that bell for notifications. And I look forward to seeing you all again next week.